Right, so now it is definitely recording. So it will be emailed to you within about 24 hours of this webinar ending. This webinar, I hope to finish hopefully within about an hour, hour and a half. It could possibly be longer depending on a Q&A. I don't anticipate a break, but if we do get to a situation where maybe, you know, people are flagging a little bit, then we might have maybe about a 10-minute break or so, but I don't plan to take up your whole evening. The longest I want to be here for is until maybe, you know, 9:30, possibly 10 o'clock, depending on how the webinar goes. And there will be a Q&A, question and answer, at the end of the webinar. You guys can't see each other's messages, but I can see all of your messages. So any questions that you do have, just write them down as I'm going along. And then what I can do is I will, at the end of the webinar, I will answer them. But also at the end of certain sections, I will just ask if, you know, people are following, if the majority of people are following along, because fundamental analysis isn't the most sexiest subject in the world. It's not like technical analysis. And there are some concepts. I'm gonna try and make them as simple as possible. But if you aren't following along, I will kind of ask at the end of each section. And hopefully, if the majority are following along, then I'll just continue on. If the minority have having maybe a bit of problems understanding, then depending on how many people are having problems understanding, I may just go over certain things. But if it's just one person or two people, then unfortunately, you're gonna have to ask at the end of the webinar. So let's get started. Right. So don't know if many of you have seen this on my channel, my YouTube channel, but I posted it. And I think it's a great quote by a market maker for HSBC. I'm not sure if he's still there now, but as at the time of writing his book, Brent Donnelly was a market maker at HSBC, and the book is called The Art of Currency Trading. I advise everybody in here to spend if you're going to buy any book on fundamental analysis, definitely get that book, The Art of Currency Trading. It's a brilliant, brilliant, brilliant book, right? And one of his quotes in there, one of the things that he says is, it's fine to specialize in one type of analysis or one trading style, but to be a great trader, you need to have a complete understanding of the markets. And for what it's worth, in my 20 years of trading, I have never worked with a single top-notch FX trader who used only technical analysis. Yeah, page 73, go to that. Yeah, I would agree in a sense that I tried trading technical analysis alone and it never really worked for me. Fundamental analysis, like I said, is not the most sexiest thing in the world, but once you get it, once you understand the rules, which I'm going to show you in this webinar, it will all make perfect sense. So another important thing that we need to establish as well is that price is not always a reflection of value. Hence why an asset can be described as cheap or expensive. Just because price is at a certain level doesn't mean that's the value. And really, fundamental analysis is understanding when something is undervalued. It's when something is a bargain or a cheap price, you know, buying at wholesale. Yeah, that's basically what this is all about. Yeah, and you can't, I don't think it's possible to do that just using technical analysis. I'm sure there are obviously models and smarter people than us that, you know, that can do that. But generally, to the retail trader, it's, you know, just looking at a price chart to establish whether something is cheap or expensive is nigh on impossible, especially in currency land as we trade, you know, pairs, right, based on the quote currency. Anyways, what quickly is fundamental analysis, right? There's many different definitions, but ultimately fundamental analysis is the study of macroeconomic factors that determine the value and price of assets. Yeah, and in Forex world, yeah, all roads lead back to GDP, inflation, and interest rates, or what is known as central bank monetary policy. Yeah, whether you look at I don't know, retail sales, whether you're looking at manufacturing, all of those little microeconomic, I guess, factors all lead back to the macro. Yeah, it's all about having that bigger picture view And all roads lead back to GDP, right? Gross domestic product, inflation, and interest rates. Yeah, this is what we are looking at. Yeah. So lastly, one of the things that I must impart on you is that it's not necessary to try to know everything about fundamental analysis. Fundamental analysis, you can go down deep into like a black hole of trying to understand every single thing and how everything interconnects. It's not necessary. Yeah. What is necessary though is to identify and focus on what has been proven to have a consistent and significant impact on value and price. So I'll get questions on things like, well, what about money supply, M1, M2, M3, etc. That, while it's worth, maybe having a little read up on it, it's not something that you need to be concerned about, right? There are things to be concerned about, and the things to be concerned about is going to be what I'm going to show you. Outside of what I'm going to show you, there really is hardly anything else that you really should ultimately know about when it comes to fundamental analysis and Forex anyway. Right. So the myths and misinformation about fundamental analysis, and many of you may be, in here and be susceptible to these myths, right? Or have heard these things. And I really want to just dispel these myths quickly. First one is that you don't need fundamental analysis. There's a lot of information online talking about, and I guess analysts saying that you don't need it, right? Whether it's a myth or misunderstanding. And ultimately, you know what? You actually don't, right? But as Brent Donnelly said, in his 20 years, he's rarely met a top-notch trader, yeah, that has basically been trading technical analysis alone. And I'm not saying that you can't be a top-notch trader only trading technical analysis, but once you understand fundamental analysis, trust me, it's like you'll look back and you'll think to yourself, how the hell was I even trading bloody technical analysis, only? Because fundamental analysis is really the reason why prices move on a price chart in the medium to long term, right? So, and the second thing is just understanding that why don't you need fundamental analysis? Well, the banks use fundamental analysis, right? The banks, and if you're in my mentoring group, my Discord group, we have access to lots of bank analysis, economic and financial analysis, right? This is not driven by a level of supply or demand or support and resistance or Bollinger Bands or anything like that. They talk economic and financial analysis when they're doing their analysis, right? Citibank, for example, these are just two. I've got, banks from Japan, Mizuho, and the like, as well as American banks and so many different bank analysis that we look at, yeah, that ultimately they use fundamental analysis. Yeah, they understand the fundamentals and they publish these reports, on a regular basis to their clients, right? The second one is the mainstream media are misleading you, and there have been instances of the mainstream media. I'm not necessarily the most trusting person of mainstream media myself, but when it comes to certain publications, like Bloomberg, for example, like the Financial Times, reputable news publications, these guys are not trying to mislead you. Yeah. Again, there are instances where there has been, misdirection and the like, but you got to think about these guys' credibility, right? They're bringing on guests, banks, economists, forecasters, etc., right? Market makers to come on TV and speak to a certain demographic of people. Now, if they were trying to mislead everyone all the time, yeah, then they would have no credibility. They wouldn't be credible, right? So the mainstream media in general, if you know what to look for, and I'm going to show you how to, basically go through, and when you look at certain news reports, is really kind of understand what exactly they're saying, you'll understand that in fact there is a wealth of information. There's so much information, so much valuable information that you really can't and shouldn't be doing without. And this is generally, it's all free. It can be found all free. There are paid subscriptions, but it can all be found free online, even though I do advise, if it's within your budget, to pay for Bloomberg. It's well worth it. And the final thing is buying and selling, fundamental trading and fundamental analysis, regardless of what, you know, other YouTubers and TikTokers have been saying, is not looking at Forex Factory or any other, you know, news calendar site, yeah, and buying and selling based on news events. You know, if something is good, you know, forecasted, it's coming out a certain number, and then the actual comes out and it's positive, then you buy. If it's not, then you sell. That's not fundamental analysis trading. You have to look at the bigger picture. In fact, surprise, surprise, I haven't traded a news event like in the way that, as far as, you know, news releases buy or sell for, you know, for ages. When I say ages, I'm talking about maybe a year or so. I haven't literally traded the news, as far as looked at the news, waited there, and then literally pressed buy or sell at the release of data. Because there's no need. And I'm gonna show you, will I show you in this video? Actually, I don't think I will show you, but I've explained it in other videos. And in fact, I do have it. I have a video in here that you can click on that shows you basically live analysis that I did in a recorded live webinar session where we were actually trading FOMC a few weeks ago. And you can see that on YouTube, and I'll show you the link. Anyways, so Forex fundamental analysis, the rules to the game. And again, just to oh, sorry, 1 second. So Apoku Emmanuel says, please, want to know if you are talking, because I can't hear you, unfortunately. I can't help you, Emmanuel. Yeah, I can't do it. I have to just log in and log out. So Forex fundamental analysis, the rules to the game. By the way, can everyone else can hear me, right? Everyone else can hear me. If type a yes in the chat box if you can hear me, please. Yep. Okay, excellent then, brilliant. So it's just Emmanuel, right? So the Forex fundamental analysis, rules to the game, yeah? So GDP, inflation, and interest rates. Those are the three things you must focus on. Everything evolves around these three macroeconomic factors. So rule one, gross domestic product. Again, I'm trying to make it as simple as possible because there's lots of things to learn about GDP, but ultimately it's this: gross domestic product. GDP is the total monetary or market value of all finished goods and services produced within a country's borders in a specific time period. As a broad measure of overall domestic production, it functions as a comprehensive scorecard of a given country's economic health. What does that mean? So we all understand economic cycles in a sense that we understand booms, busts, contractions, recessions, etc., right? And we should know what that means, right? So basically, when a country is going into recession, it's not doing so well. Economic output has slowed down. You know, unemployment is high, employment is low, etc. In a boom phase of the economic cycle, or the expansion phase, you've got a growing economy, you've got booming businesses are making money, and you've got high employment and low unemployment, right? Think about last year when the coronavirus hit, we went into, you know, a really kind of, you know, quite a deep recession, a short recession, to be fair, a very short recession, considering, but we went into a recession nonetheless, where lots of people lost their jobs and livelihoods, etc., right? And it's important to understand where a country is in its economic cycle, because money will flow into a country, right? If you're an international investor, businesses, etc., doing mergers and acquisitions, etc., right? You're going to focus on putting your money in an economy that is growing, that is booming, that you're going to get a return on, and you're not going to keep your money in a place where unemployment is high, right? And employment is low, right? And businesses are struggling going into the recession, they're closing down, etc. So just think about it from that perspective. You're an investor, and you're an international investor looking at the world as a whole. What countries are you looking to invest in, and what countries are you not? Because that is where, from a very simplistic perspective, that is the truth of the matter. And that's where money will flow into and out of, just as a standard, right? So what we're looking for is divergences and understanding as we trade in pairs. Obviously, if one currency is going into the boom phase or the expansion phase, another one is going into the recession or the bust or slump phase, that's a divergence that you want to trade. Yeah. Rule number 2, right? Rule number 2 is inflation and interest rates. Now, this isn't the most exciting thing, but I'm going to try to simplify this because this is very, very important. And it's my belief that the powers that be, the people that basically labeled all these terms, and the economists, etc., they deliberately. I was having a talk with a trader the other day that I think they deliberately made the language around this confusing because it really is actually simple to understand, but it's a bit backwards in a sense. And I'm going to explain it like this, right? So simply put, Aryan says, why does currency rise when GDP fall? Right, Aryan, do me a favor, and everyone else is listening. I did explain this at the beginning. Please save your questions. Please save your questions to the end, right? Please save your questions to the end. I will ask at the end of a section whether you've understood. Trust me, I'm about to get to this. So please, everybody, just save your questions to the end, because otherwise it messes up the flow of things, right? So inflation is basically prices, yeah? So inflation is the decline of purchasing power of a given currency over time. Essentially, it's currency devaluation, right? It's currency devaluation. And let me just get my pen tool out, right? And here we go, right? So think about this as inflation as devalue, D-V-A-L-U-E. Oh, sorry. What's going on with my, I'm on a trackpad. A-T-I-O-N, right? Just think about it as devaluation. The higher inflation goes, right, in this direction, in this arrow, yeah, is the more devalued the currency gets, yeah? And deflation is the increase in purchasing power of a given currency over time. So currency appreciation, right? So this is appreciation, right? A-P-P-R-E-C-I-A-T-I-O-N, yeah? This is currency appreciation. So the currency is getting more expensive, yeah, over time. Yeah, so appreciation and devaluation. Yeah, everyone following so far? Everyone following so far? Yeah. And if you don't believe me, you're doubting me, you can Google it, right? You can Google it. This is what it is. I'm not telling you my theory. This is what economic theory is. Yeah. So the more inflation rises, the more the currency is devalued. Yeah, Marianne, I know a lot of people they question me. I had a question about it earlier, and yeah, it was just a bit silly, the question, but not in this group, but on a private email, right? But so the more inflation rises, the more devalued the currency gets, and deflation is actually appreciation. Yeah, so you can start to see where the language starts to get confusing, right? Because in means increase and D means decrease, right? But in fact, inflation is devaluation. Interest rates, right? So basically it's prices. So think about inflation as prices, right? Prices or purchasing power. Yeah, so price or purchasing power. Now, they try to control prices. Yeah, central banks try to control prices through monetary policy, meaning interest rates, right? Negative interest rates and quantitative easing. Now, interest rates, yeah, an interest rate is a percentage charged on the total amount you borrow or paid on the amount you save, right? But an interest rate hike, we all know what interest rates is, but an interest rate hike, right? So meaning a hike this direction, right? So going from 2 to 3% to 4%, for example, yeah, right? An interest rate hike, when you start to hear that central banks are hiking interest rates, yeah, it typically appreciates the currency because it increases demand, right? So think about that now as appreciation, yeah, appreciates the currency. Yeah, appreciate the currency. Yeah, and an interest rate cut meaning that if they start to cut interest rates from 2 to 1 to 0 to negative to -1 to -2, yeah, that actually devalues a currency, right? So devalue, A-L-U-E, right? So devaluation. So you can start to see now, right? We've got devaluation here, we've got devaluation here. We've got appreciation here, and we've got appreciation right here, yeah? So quantitative easing is also, yeah, acts as a similar way to cuts, and it's not necessary to know the exact ins and outs of QE, but understand that when they start to announce QE, right, or they're removing QE, if they announce QE, then it's, again, devaluation, right? It's when they haven't got any more, they don't want to cut interest rates anymore, and then they start to engage in other methods, yeah, to devalue their currency, yeah? So devaluation. Now, central banks have an inflation target of 2% per year. That's mandated, by the way. Mandate meaning that they must achieve it in some way, somehow. Whether they, actually, that's wrong of me to say. They're mandated to try to achieve the 2% target. Yeah, that's what they're mandated to do. They have to enact central bank monetary policies, yeah, and like either cutting rates or hiking rates to achieve this magical figure of 2%. Yeah, that's the goal. That is the goal, right? So if inflation is above, right, if prices start to rise above the 2% target to 3%, what is happening? The currency is getting more devalued, right? So in order to combat that, they have to enact policies that appreciate. So it's like a seesaw. It's like a weighing machine. They have to hike rates. Yeah. Everybody follow. Yeah. So it's like having a scale. Yeah. If something goes, if something gets devalued, yeah, they have to add something, yeah, a heavier weight to try to balance out the scale. That's what they're trying to do. So devaluation, yeah, you all understand, brilliant, you're all following. So devaluation, yeah, needs appreciation to bring it back down. Yeah, to bring it in line, you need to appreciate the currency to bring inflation down. Now, the other way, yeah, if we start suffering from deflation, meaning that the currency is starting to appreciate, yeah, and get expensive, then the central bank needs to enact measures to do what? To devalue the currency. Yeah, they need to devalue the currency in a deflationary environment. So deflation, because they have to try to control prices. They can only control prices via monetary policy, and that's either hiking or cutting or even holding rates, yeah, or QE. So you can now see what happens in this cycle, right? If inflation starts to go -2, -3, what do they have to do? So this is getting more and more expensive. It's appreciating more and more. So the central bank have to do what? Cut rates even more, or QE, to try to get inflation back to their 2%. They need to try to devalue the currency to get it up here. So that starts to go like that. Yeah, it makes it unattractive. Negative interest rates, basically, to keep your money in a bank, you're paying the bank to keep your money in the bank. If you go to Japan or you go to Switzerland at the moment, negative interest rates right there. They don't want savers, they want spenders. They need to devalue the currency because their currency is very expensive. Deflation, so they need to achieve their 2% devaluation target. Yeah, and that's very important, guys. This is if you get anything from this, because ultimately you're going to see in the news that central banks will tell you, the bankers will tell you what they're going to do with interest rates, right? And what is happening with inflation. And then you can start to buy and sell currencies based off of monetary policy and what inflation is doing. This is how the game works. This is how it works. There's now, like, I can't emphasize and stress enough. This is basically what it is. This is the rules to the game. Rule number 2, the relationship between inflation and interest rates and monetary policy. Yeah. Does anyone not follow, by the way? Is everyone not following what I said? If there's silence, then I'll assume that everybody's followed me. And I'm going to show you an example of this, by the way, on the euro dollar from last year. We'll go over a whole year's worth of trading and looking at this in action, by the way. So it's not just theory. You know, if you were in my group, you would have known this was happening. This is definitely happening. We traded all of this on the euro dollar. Yeah, excellent, all good, brilliant. I'm doing well. I'm doing very well. A real life, yeah. So Omar, it's coming. it's coming, right? But you follow so far, right, Omar? Yeah, you're following so far, correct? You understand the rules. Yes, these are the rules. Get these rules, then that's it. Burn them into your brain because they're really going to help. So let me clear this. Right, excellent. Let's move on. Yes, no worries, Dixon. Right. So the next one is a bit of a shortcut, but again, it's another rule. So you can actually determine, yeah, where you are in the economic cycle, because I get questions all the time. Where are we in the economic cycle? We are. You can tell by what the central bank is actually doing, right? So rule 3 is interest rate cycle, right? Monetary policy is knowing which part of the economic phase you're likely in. Yeah. So when you're in an interest rate hiking cycle, which is what is tend to be known as tightening, yeah, you are generally and typically in the expansion or the boom phase. So when you see, or sometimes the recovery phase, yeah, but you're generally in the expansion or the boom phase when central banks start to hike interest rates. Now, when they start to cut interest rates, yeah, you're generally in the contraction, recession, bust, or slump phase. Yeah. And when central banks are holding, they are adopting a wait and see approach. Yeah. Recovery, right? They're in the recovery phase and sometimes in the contraction phase. Yeah. So generally, right, typically what you want to do, if you don't know what phase of the economic cycle you're in, you should know, really. But if you don't, the best thing to do is to read up on what central banks are doing, what the European Central Bank are doing. Are they hiking, holding, or cutting rates? What is the Reserve Bank of New Zealand doing? Are they hiking, holding, or cutting rates? Because ultimately that will tell you where the bank, the smartest guys in the room, think they are when it comes to where they are in the business cycle. And then ultimately, you know, you can make your decisions based off of what they are going to potentially do with the currency or what they're aiming to do. Of course, decisions are dependent upon inflation and economic data trends, right? So it's not written in stone. These are things that, when I say written in stone, I'm not saying that there's going to be anomalies, there's going to be situations, and I'm going to get into something, for example, like stagflation, where central banks will be in a very difficult spot. And in fact, right now, there are certain countries, and the talk is about stagflation, right? Especially typically with the UK, right? The UK economy, stagflation is being banded around. And I'm going to talk about that in a sec, so don't get confused. But ultimately, we need to know, if you want to know where you are in an economic cycle, look for what the central bank is doing and what they're looking to do. If they're looking to tighten, hike interest rates, you know that they're in the expansion or the boom phase, or at least heading into that, in that direction. So let me just clear this. Clear all drawings. Right. Using fundamental divergence and convergence to select currency pairs likely to trend, right? So this is what everybody, Marianne, you finally get it. No worries, no worries. I'm glad the light bulb is switched on, and it does for everybody, right? So ultimately, yeah, what we are doing as fundamental traders is we are looking for divergences, right? So we're trading, you know, one of the most traded pairs, or if not the most traded pair, is the euro dollar, right? So ultimately what you're looking for is divergences, yeah? Divergence meaning one's going higher, one's going lower. Oh, a little arrow, but in monetary policy. So what you want to see is, for example, one of these currencies. So I'll give you a real life example, right? So the dollar at the moment, right, currently is in the recovery phase, right? But they're ahead of the recovery. Everyone's in a recovery phase because in globalization, a rising tide lifts all boats. But the US economy is actually ahead of the European economy, right? Because they're looking to do something called taper, which is basically a reduction of bond buying, which is basically buying government debt, but they're also thinking about hiking rates potentially next year, so 2022, right? That's exactly what the Federal Reserve are talking about right now, a hike in rates. Hike meaning positive, right? I'll say positive, but they're looking to appreciate their currency. The European Central Bank, on the other hand, are not, right? They're just not. If you look at, for example, jobs, right? Or you look at, actually, let's look at the economy, for example, GDP, right? GDP, the US economy is ahead of Europe, right? They're ahead of Europe. Europe is stagnating. The US are in that recovery stroke growth phase, right? Inflation, right? Inflation. Remember I was saying to you that the 2% target must be met, yeah? I think Europe are somewhere around that 2% target, but they're quite dovish in a sense that they're not looking to hike interest rates at all, yeah? At all, really, for the foreseeable future, whereas there are potential targets for the Federal Reserve to hike rates, right, in 2020, 2023, based off of inflation being, I think it's 5.3%, something like that. I think it's 5.3 last time I looked at it, 5.2, 5.3, right? Which is way above the 2% target. There's more pressure on the Federal Reserve to have to hike rates due to inflation being way above their 2% target than there is for the European Central Bank. So money is flowing into the euro dollar. And if you see, we can all look at a chart, right? All look at a chart and we can see what's been happening as of recent, right? On the daily time frame chart, weekly time frame chart since, you know, when was it? I would say probably June, probably May, June times. You've seen pretty much a really nice downtrend. And that's pretty much what's been happening. I'm going to go over this as well, right? So what you're looking for is divergences, right? You're looking for divergences or convergences, right? So what are convergences? Convergences are when a strong currency gets weaker, right? Or when a weaker currency actually gets stronger, right? Because in fact, a weak or a devalued currency, yeah, can actually boost GDP. Right? And an expensive currency actually hurts GDP. Why is that? The reason why that is, right? So if you think about a cheap currency or devalued currency, yeah, if you think about it from the perspective of imports and exports, or matter of fact, think about it from the example of shops, right? If you have, you know, 3 shops, actually, I'm not going to draw the shops, but you have 3 shops, and this is the most, they're all selling the same product, yeah? This is the most expensive, yeah? And this is the absolute bargain. Everyone's going to go to this shop to buy their goods and services, right? If you're doing some shopping, food shopping, or whatever it is, right? And they're both selling the same product. Yeah, it's no different. There's going to be more demand for the cheaper shop than there is for the most expensive one if they're selling the same goods at the same quality. Yeah, same thing applies to GDP and imports and exports. Yeah, if a country's currency, I put export, I suppose put expensive, right? ENSIVE, sorry, right? If a country's currency is expensive, yeah, the world is going to look for a cheaper exchange rate, right? Why? That's the reason why China is the world's economic engine, because their exchange rate is very, very cheap. Everyone goes to manufacture in China and then exports it to the rest of the world, yeah, because they have a cheap exchange rate, yeah. So a cheap currency, yeah, a devalued currency can boost exports. And boosting exports is basically just saying that the country can actually sell, yeah, more than they actually import, right? If a country is exporting more than they're importing, that's good for the economy, keeps it growing, right? If they're importing more than they're exporting, that isn't good for the currency. Same thing, like for example, like a shop. If you're selling more, yeah, if you're selling more than your overheads, yeah, and your expenses, then you're making money. Imagine you're running a business and your rent, your ground rent, your lease, whatever it is, and your wage staff and your wage bills, etc., is through the roof, but you're not getting any customers coming in. Of course, you're paying out more than you are selling. So it's just, there's no different with countries. So countries are on a permanent, they're on a permanent cycle where they go from expensive, yeah, eventually to cheap, to expensive, to cheap. It's a constant cycle, yeah. So this is what the reality of things. So if there's more export because of the cheap currency, it will, no, if there's more export, it should grow because you're selling more. Yeah, you're selling more of that currency, of that product, because they can buy it, because people can buy it for a cheaper price. Yeah, demand for that goods and services is going to go up. Just think about it in a shop. Where if you're going to go and buy some a Louis Vuitton belt, right, for £100 or £50, yeah, and it's the same exact belt made, official, made by Louis Vuitton, you're going to go to where you can get it cheaper, correct? So do you think that shop is going to do better than the expensive one? Of course it will. Right? So an expensive currency can hurt GDP and a cheap currency can actually boost GDP. Yeah. So when you think about it like that in divergence trades or convergence trades, right, from a converging perspective, there are opportunities where an expensive currency is actually hurting the currency, and the devalued currency or a weaker currency or a cheaper currency actually boosts exports. And you'll see that reflected in GDP, right? You'll see the GDP of a currency or a country start to come down, yeah, trend down, and you'll see, in fact, a currency or a devalued currency for that country start to boost exports. And in fact, you'll start to see a trend in GDP going higher. So there are times where you can trade convergences, right? Convergences. That's what divergences and convergences are. And what we do from a currency perspective is understand the biggest divergences and biggest convergences from the country. Yeah. So again, just do a list, right? You're going to do a list. You're going to do GDP, right? You're going to do inflation. Yeah. And then you're going to see whether the central bank is going to be doing something with rates. Yeah. That's ultimately what you're doing. Yeah. And then you're going to say, who's winning the war, or who's winning GDP? Who's ahead of GDP? Is it the euro, right? Or is it the dollar? Right? Dollar, tick, brilliant. Inflation wise, are they above the 2% target or below the 2% target or at the 2% target? Right? They're likely to hike rates. Inflation is above that 2% target, tick, right, for the dollar. Interest rates, looking to hike rates, yeah, the US dollar are brilliant, excellent. That's the currency you need to trade. That's the currency you need to buy. And then you look for a currency that is weak or weaker than the euro, right? If you've got two currencies that are competing against each other, they're both growing, inflation is both high, and they're both hiking interest rates, don't trade that currency. Yeah, so what do I mean by GDP ahead with GDP? Yeah, in terms of figures and the trend, right? In terms of figures, because that's how we measure GDP, right? In the percentage. Yeah, but I'll show you the sites to go on as well. By the way, I'll show you the sites to go on, right? So that is what you're looking for: GDP, inflation, interest rates. All roads lead to this, and then you're looking for the biggest divergences and or convergences, and that is what we do from a currency trading perspective. What do you mean? You say you guess not. What do you mean, Excel? What do you mean you guess not? Does everyone understand what I'm saying, by the way? Is everyone following? Or I should say, matter of fact, who is not following? Who is not following? Who is not following? Just put not follow. Put not follow in the chat box. So you're not following about the GDP. You're not following about the cheap currency weakening the GDP. No, I didn't say that. I said the cheap currency boosts GDP. Excel. Yeah, it boosts GDP because, as I said to you, an expensive currency hurts GDP, can hurt GDP, and a cheap currency can boost and helps GDP. Yeah, yeah, you get it. Okay, all right, brilliant. So that's something to keep in mind. Yeah, right. So cool. All right, and here is another, just quickly, another way to look at understanding monetary policy expectations, right? So the currency, yeah, you can find these. No, it's not inverse to interest. It's not in GDP is not inverse to interest rates. GDP is its own separate thing. Yeah, it's its own separate thing. I have not correlated GDP to interest rates. I don't know where you got that from. So the point being is this, yeah, is you got monetary policy expectations. What are you talking about basis points for? Basis points. Anyways, let me finish. I'm going to finish because you're disturbing the flow of things. Please keep your questions to the end. Yeah, questions to the end. Right. So we already understand that the that when a central bank starts to hike rates, that appreciates a currency. Correct? That's one of the rules to the game. When they look to hike rates, it looks like the currency should get more expensive, right? On here, you can see that the central bank of New Zealand, right, which is here, the purple, are looking projected to hike rates sooner. Next is the Bank of England. And then you've got, looks like, can't really see it there, but Canada. And then you've got, looks like the RBA and the Federal Reserve. And these are the projections from Westpac. So ultimately, what you're looking at is the central bank that is least likely to hike rates, yeah, more severely, which looks like the ECB at the moment and the Bank of Japan. Yeah, because they're still down here somewhere. Those are the ones that you need to sell. The RBNZ, right? Reserve Bank of New Zealand, Bank of Canada, Bank of England are the ones that you need to buy. Yeah, because these guys are looking to hike first. Yeah, they're looking to appreciate their currency first. So if you go and look at these currency pairs, right? Go and look at the New Zealand, Euro New Zealand, and tell me what you see. Yeah. Go and look at the Euro CAD and tell me what you see. Yeah. Tell me, go and look at it and tell me what you see. All right. You should see that trend down. You should see that trend down. Yeah. Can anyone just go there and have a look and then tell me if that's not what is happening on a daily time frame chart? Don't look at a 5-minute chart. Look at the daily time frame chart, and you'll see that is basically what is happening. Yeah, it's not because there's some Elliott wave 3 and we're in, Elliott wave 4 or anything like that. Yeah, it's nothing to do with that. That has nothing to do with why currencies move. It's not technical analysis. This is what you need to know. So if you can find, and again, in our group, we have all this information. You can see where the central banks are actually hiking rates or when they're not looking to hike rates, right? And of course, this isn't necessarily everything was all set in stone. I've got another thing to go over, which is to do with slippage and liquidity. But the European Central Bank, they're not looking to hike rates at all, right? You can see it right here. Yeah, this is ING, their forecast. The only thing they're looking to do is potentially do a balance sheet change, but they're not looking to hike rates at all. Yeah, no hike in rates 2022, 2023. Yeah, but you see in the Federal Reserve, yeah, look what they're doing. They're tapering, hike. That's the expectation. Hike. Right, and you see in the euro dollar do this. It's not a mystery. There's no mystery. Bank of Canada, right? Look at Japan, right? Bank of Canada, right? That currency pair, yeah. They're not doing anything. They're not doing a thing with their monetary policy. But look what the Bank of Canada are doing. They're slowing QE, which is positive for the currency. They're looking to hike potentially in Q1, Q3, Q4. Go to the bank, go to CAD yen right now. Go into your charts and look at the CAD yen and look at what's been happening. Look at what's been happening. All right, look at the chart on a daily chart. This is no mystery. This is not a mystery. Yeah. These are the rules to the game, guys. This is the rules to the game. Yeah. So let me go forward. Right. What time is it now? Okay, probably another hour or so. Do you guys want to have a little bit of a break, or do you want me to keep going? We do a little bit of a vote. Break, just put break or going. Break or going, break or going. Keep going, going. All right, I'll keep going. Right, 1 second. Let me just get a drink of water because it's difficult to. Yeah, thank you. All right, now I'll keep going. Don't worry. 1 sec. Right, stagflation. Stagflation. So, what is stagflation? And you must be aware of this. You must be aware of stagflation because it's not all a bed of roses, right? It's not like, okay, this means this and this means this, and then that's going to be it, right? Time is money, says Adrian, of course, right? So stagflation, there's a problem sometimes. So stagflation can be defined as a period of rising inflation above the 2% central bank target combined with a decline in GDP, right? So what does that mean? There are times in history where you have, let's say, for example, you have GDP, you'll see something like this, right? It's steadily growing and then inflation is growing, right? At the same time. Remember that central banks try to control inflation through monetary policy, yeah? Now that is what they want to see. They want to see GDP growing. They want to see it in the boom or expansion phase. etc. But what happens sometimes, what stagflation is where you have growth, GDP growth, or say starts to contract, yeah, and the contraction phase of the economic cycle, but inflation is still going higher. There's a dilemma there. The dilemma is because central banks don't want to hike rates. Yeah, let's say, for example, it's, inflation is at like 4%, right? Now, we've got a bit of a downtrend coming, or a contraction and a slowdown in GDP. Why is this a problem? The reason why this is a problem is because central banks don't want to hike rates, because it can, and it's likely to hurt the economy. Why is that? Is because borrowing costs, lending and borrowing, yeah, in an economy becomes expensive. If you have an economy where, let's say, for example, unemployment starts to go higher and employment starts to go lower, right? And you've got, homeowners who, are struggling to get a job, right? The last thing they need on their mortgage, yeah, is for a bank to then turn around and say, well, now you've got to pay more on your mortgage because of interest rates, because of inflation, sorry, right? We're going to hike interest rates. Yeah. So interest rates have a direct effect, in a sense, yeah, on the economy, right? So in order for interest rates to be hiked, the GDP has to be able to accommodate that, right? In a growing economy where people have got lots of money, lots of jobs around, business is booming, they can afford to pay back their loan, a loan that was once maybe, a 1%, maybe it's 1.5%, because the central bank has hiked interest rates. Fine, brilliant. You know what I mean? Because employment is going higher and unemployment is going lower. Fine, they can do that. But when it's the other way around, a hike in rates, especially in a potential downturn, is what's known as stagflation. Yeah. And the long and short of it is when you hear the word stagflation in an economy, yeah, the central bank are in a conundrum. Yeah? They are in a conundrum. Nobody knows ultimately what they're going to do, because it's almost like they're damned if they do and they're damned if they don't. If you see a currency that is heading into stagflation, or the news are talking about and the media are talking about they're in stagflation, yeah, just don't trade the currency, right? That would be my best advice, because if the bank are unsure about what they're going to do with interest rates, whether they're going to hike or not, etc., then then how are we gonna supposed to predict what they're going to do? These are the smartest guys in the room. There are other trades out there. There are other countries out there, yeah, that are not in stagflation. That is where it's clear that they're growing or they're shrinking, for example. When you start to hear stagflation, don't trade the pair. Yeah, you can either not trade the pair, or personally, I'm more likely to short the pair. But there are nuances to that. For you guys who are not in the group, I would just say to you guys, it's best not to trade anything where you see or hear the word associated stagflation to that country. Yeah, avoid that. It's important to know. Right. So moving on. Right, so gathering fundamental information or evidence, I should say, to support the trade idea. So once we've got our trade idea, and I guess what we should be doing at the same time, and what you should have, as a tab, is you should have. Yeah, it is good. It's great to know about stagflation. It's very important, right? So gathering fundamental evidence and confluence. And because we need confluences with our idea. There's no point in just having this idea and, you know, we go off and trade it, right? You want to have A, the data, and B, the smartest minds and the analysts and the banks and the financial institutions on your side. They want to be seeing the same thing as you. And this is why when I go back to talking about, you know, the news isn't always, you know, intentionally misleading you, it's because they have to go on, you know, certain news publications and tell you this stuff. But the average retail trader who doesn't understand the rules to the game, yeah, they are just like, well, you know, technicals are saying this, technicals are saying that. Technicals aren't saying, it couldn't tell you what the central bank are going to do. That's nonsense, yeah? And the people that go on these well-trusted publications are on there, they're trusted for a reason, right? Because they can't go in there and say, well, we're gonna, in the face of a recession, we're gonna hike rates. That'd be stupid, right? And they wouldn't have any credibility. So what you want to do is first of all, economic data. You can find that at tradingeconomics.com. This is my #1 go-to site. This is my #1. All the data is here that you need. Yeah. So what you can do is go to indicators, right? Go to countries, choose your country, United States. Then at the top, you've got tabs, GDP, labor, prices, right? So GDP, the one that you want to pay the most attention to, or the two, is growth rate. Is for sure growth rate, right? And then annual growth rate as well. But growth rate is what you want to pay attention to. Labor, definitely unemployment, non-farms. Prices, inflation rate, yeah? And this gives you last. So inflation rate was 5.4 in September. The previous was 5.3. So you know where the trend is going, right? Look at inflation. Yeah, it's funny because if you look at, and you can see with inflation going higher and higher, the central bank are doing what? Are having to do what? There's talk about what? What is there talk about with the central bank? Hiking rates, right? Interest rates. Yeah, exactly. Yeah, Fed likely to start tapering this year. Talking about tapering is basically the first step towards hiking rates. Yeah, so they're looking to hike rates. Yeah, and you, by the way, as well, in the interest rate tab as well. So federal funds rate. This is a really good news stream. Gives you a nice synopsis of what is happening. So Fed signals taper will start soon. So Fed signals taper will start. Right? It's giving you the important information that you need in order to make the decisions to buy or sell a currency. This is pretty much what we do. Yeah. So you can go into any of these. So it's indicators, countries, and then you've got all your countries here, and you're looking for divergences, right? Central bank statements, always good to look for. Again, you can find them, find a synopsis in here. If you go there, you go to is it money, interest rates, and then you get a little bit of a synopsis, a news stream, or you can just do a Google search for ECB statement, and then it will just bring up, you know, the statements for you to read. And there's lots of news publications like as well, Bloomberg, so reputable publications. Think ING, one of my favorites, Pound Sterling Live. You don't need a whole load, by the way, of news publications, right? I have probably about 5 that are my main go-to, because if it's not on Bloomberg and it's not on the Financial Times, then it's probably just not worth even considering, right? You want to stay away from, you know, some one man in his blog in his bedroom, you know, theorizing about the crash of the stock market, right? Don't do that. You know what I mean? Go to the bank's website. You know what I mean? Go to the analysts that gather the bank's websites, bloomberg.com. Bloomberg obviously is a paid subscription. Financial Times is a paid subscription. I pay for those because, and there's a reason why. It's really, you can get really good information from the free sites. Don't get me wrong, but Bloomberg is where they're generally getting, you know, some of their a lot of their information from, right? And there's a reason why it's paid. And again, if you have got, you know, the finances, I highly advise one or the other. You don't have to do both, but I would probably say Bloomberg. And the Guardian business blog is something that I really like to keep my eye on. Right. And once you've, for example, chosen or you're starting to read those articles, right, you're looking to find articles and topics, right, on economics, GDP, inflation, interest rates, central bank speeches, right, anything to do with what we're looking for, right? So with quotes from banks, analysts, economists, money managers, etc., right? That's what you're ultimately looking for. So Bloomberg, in fact, you know, I should have had a couple ready and I didn't have it. I should have had it ready. But yeah, if you're in Bloomberg, what you do is go to menu, you go to markets, economics, right here. One sec, sorry. Let's do that. Right. Now, when you're on this page, look at the headlines and then look to see, right? Investing, yeah, exactly. But just choose a few, right? Someone says investing.com is good as well. Yeah, but just choose, you know, your sites, a few sites. And trust me, if it's on those major sites, then it's everywhere. Then what you want to do is just look for, and I think these guys have a central bank, right? So economics, right? Erdogan central bank gambit says Turkey. We're not interested in Turkey. Cool. But what we are interested in is Bank of England, right? So two Bank of England officials push back on talk of imminent rate hike. So they push back on talk of imminent rate hike. That is an interesting article because I haven't read this yet. But I won't do this live, of course, because I don't want to drag it out. I've got still a few more things to talk about, right? But this is something that you want to pay attention to, talking about rate hike, right? They push back on talk of imminent rate hike. So two Bank of England policymakers signaled they are in no rush to raise rates now. So that's, again, even better for the pound. If you're in any pound trades, that is a great. So when I say pound trades, I'm talking about pound short, which I'm in. I'm in the pound New Zealand at the moment. That should be good for my trade, right? Pound New Zealand hopefully is selling off, right? But that is telling you that they're not looking to raise rates anytime soon. Yeah, they've done a bit of a U-turn. So then you can start to now look to potentially short the pound. And by the way, the guys in the group, I know Marianne is new to the group. He knows for sure that I've been saying short the pound for the past. Yeah, exactly. I was right, wasn't I, Marianne? Exactly. I was right about shorting the pound. Anyways, that's what you want to do. Yeah. That's what you want to do. And then also as well, look for price forecast. Now, there's a really good site. And again, I should have had this up. Sorry, guys. I should have had this website up. Yeah. Again, this site is great. Bank price forecasts, because ultimately, yeah, you want to look for forecasts, the bank's forecasts. And in fact, I'll take you to ING's one, a bit simpler. ING, right? They have a forecast section here. And if you go to FX, notice how they do GDP, inflation, policy rates. Yeah, that's what they're focused on. They're not focused on retail sales. They're not focused on home builders numbers or nothing like that. Yeah, GDP, inflation, policy rates. And then you got FX. Now, what you got here is our forecasts. Yeah, forecast. And their forecast was that on the 8th of October, so it was recent. Now, the Euro forecast, yeah, 117, 115, 113. So you can see that they're forecasting a downtrend on the euro dollar. Yeah, dollar yen, 112, 113, 115, 118. And that makes sense, right? Because of everything that we've been talking about. So it's not just me saying this, by the way. It's not me saying, oh, well, you know what? My theory suggests da, 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 da. You need the banks to obviously be on side as well. And you can see this play out pretty much what they're forecasting, right? So ultimately, what do you do with this? If, let's say, for example, the euro dollar was at 118, yeah? And you were at a level of, for example, support. Let's say, for example, that was a support level, right? And that was 118. Would you want to take that trade long? It's giving you a nice pin bar. It's giving you a nice engulfing candle. Do you want to take that trade? How many people in here are taking that trade at 118? Adrian says no. Who's taking that 118 trade? I'm going to assume that everyone's quiet. Okay. Yeah, exactly. No, you wouldn't. Why? It's common sense, because the path for these resistance is to the downside, right? So if it does start to go down to 117, pulls back to that 118, that's what you want to do. That's ultimately what fundamental analysis is telling you, the direction of least resistance. Yeah, it's telling you the path of least resistance. That's what it's telling you. Yeah. And is it going to be like for example, the euro yen? Is it going to be trending all the time? Of course not, right? It might not be. It might say 131, 130, etc. Just don't trade it then. If you can't see a divergence in that, then that's it. Excel says it is not a bargain area. Yeah, so exactly. The 118 isn't a bargain. But actually, in fact, it is a bargain for the dollar, right? When you think about it, it's a fantastic bargain for the dollar. Because if you're trading the dollar, which is the quote currency, 118 is an absolute bargain, because if it's supposed to be 117, 115 by next year, 115, which is somewhere down here, in fact, it's a bloody bargain for the dollar. Yeah, it's not a bargain for the euro, of course. It's expensive for the euro, but it's a bargain for the dollar. You understand that, Excel? Because in order to buy the dollar, you need to go short. Yeah, exactly. So that 118 is an absolute bargain, cheap price. And that's why you look at forecasts to see what the forecast is. Yeah, see what the forecast is and where you are. And then you can see whether you're buying at bargain prices or not. But also another great site is this here. So it does MUFG, does a lot of banks, forecasts, TD Securities, ANZ, for example. Excellent, excellent, excellent resource. This site, exchangerates.org. The specific site, though, is right here. Yeah. Right, we've got another, probably about 55 minutes. Let me see if I can get through this, because I think you've got a few things to go through. Right, the importance of liquidity and slippage, and I have to say this, right? I have to talk about this, right? So fundamentals, generally people will have their trading strategies, right, that they trade. But you need to understand about liquidity and slippage. And the reasons why. Sorry, guys, 1 second. Just take that off. Right. And the reason why this is a must, you must understand this. So the importance of liquidity and slippage, right? So iceberg orders are large single orders that have been divided into smaller limit orders, right? So let's say, for example, a bank wants to trade £1 billion worth of, pounds, right? They can't just press buy, because there might not be enough liquidity in the market, right? There needs to be £1 billion worth at a certain price, and they must be the only ones looking to buy that. So they need enough sell orders, right? They need £1 billion worth of sell orders at a specific price, and they must be the only ones buying at that particular price to avoid what is known as slippage. Slippage being when you have multiple prices, right? Which is what happens. So if all of this represents, for example, $1 billion worth of sell orders, this price range from here to here, for example, right? And there's £1 billion worth of sell orders because these guys want to buy, remember? So you need an opposite seller. Yeah. That is what's known as slippage, because some will get filled here, 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 some will get filled here. By the time they get filled, yeah, they don't want to buy up here. That's not the way the game works. That could be 200, 300, 400 pips up. Yeah, they want to buy at bargain prices. They want to buy down here, but they need enough orders. So what they do is they scale in, right? They scale in. They have to scale in, right? And how they scale in is basically by iceberg orders. Yeah, that's what iceberg orders is the breaking up of the 1 billion into, you know, let's say, for example, 10 million here, or, you know, 20 million there, or 15 million here, for example. And they put them, they put the orders in to disguise. They don't want to tip off the market, you know, because a £1 billion order is a massive order. It's going to tip off the market, right? Everyone else is going to start to buy. So they have to break down their orders, and it's known as iceberg orders. So a large single order that has been divided into smaller limit orders, usually through the use of an automated program for the purpose of hiding that actual order quantity, because they want to avoid slippage. Yeah, short-term price, yeah, is typically random, and this is due to liquidity and the avoidance of slippage. So what do I mean by that? A lot of times you'll hear, all right, get long on the euro, but for weeks on end, yeah, the euro might be doing something like this, right? The euro might be going just sideways. And every week, let's say, for example, that's Monday, and then that's Monday, and then that's Monday, and then that's Monday, right? At the end of every week, or the beginning, I should say Friday, whatever, right? But week to week, traders will say, well, Leon said we should get long, right? We should get long on the euro dollar because the euro is, you know, hiking rates, right? Prices should be up here somewhere. But what you have to understand is that the banks, yeah, have to accumulate. They don't care about your track record and whether you got to make profit this Friday or this day, or you got to pass this type of challenge, you know, the whatever challenge that you're doing from some sort of prop firm. They don't care about that. What they care about is doing their orders, and they accumulating their orders, and they need to basically buy their orders, yeah, at certain prices, at certain low prices. And not just one bank, there are hundreds and thousands of banks that need to do, because they all see, for example, that the European Central Bank, for example, is potentially looking to hike rates. So they're all looking at buying, but they need the liquidity. They need the sell orders, right? They need to have the sell orders at this particular range and a particular price for them to buy, right? To divide up their orders. So in the short term, yeah, in the short term, price is very random because of the accumulation and the avoidance of slippage that the banks need to do, right? It's their mandate. They don't want to buy up here. Yeah, they want to buy at levels around here, at prices around here. So, but in the medium to long term, medium meaning the next 3 months, 6 months, you'll start to see prices look to trend. Eventually, the fundamentals will always play out, right? If, for example, because we don't know, right? If the data supports that narrative, right? Because you can have a rumor start, but if the data doesn't support the narrative, then unfortunately that is just a rumor and it might not go anywhere. But the central bank might not, for example, hike, for example, right? But the whole point in understanding fundamentals, you need to understand this, is that depending on your strategy and your technical strategy, you've got like some 5-minute strategy. People say, don't do 5 minutes, that's 5-minute trading work with fundamentals. If you're trading every single 5-minute supply and demand zone or 5-minute support and resistance level, of course not, because on a daily time frame chart, this could represent 200 pips, yeah, and it could blow through your levels, right? Your 5-minute levels are nothing to the bank who want to basically buy when the prices are going down, right? So in a selling environment, yeah, they need to accumulate. They need to do what? Buy, right? So when someone is selling in the downtrend, they're doing the accumulation. Yeah, they're buying in a selling market in the same way that when prices go up, it allows them to sell. Yeah, when the other side of the market is buying. That's what liquidity is. Yeah, and I'm going to show you an example of this as well. Like I said, on the euro dollar, but you need to understand this. You guys understand, by the way. You guys get that? Yeah, short-term price action can be very random. Yes, it might look like there's a support levels and prices are bouncing off it perfectly and stuff like that. Fine, I'm not saying that that's not what it is. But if you look out and you zoom out and look at the bigger picture, this accumulation can be a week, it can be a month. Nobody knows, like no one knows. Yeah, it's all right not to know. Do you know what I mean? I know a lot of people, a lot of trading so-called gurus will tell you that they know what's coming. They don't, right? They don't know, especially if you're just looking at random short-term price action. Yeah, they don't know what's going on because ultimately the banks are using minor support and resistance levels to chop traders out, to draw them in left and right, and they just hunt for the liquidity left, right, and center. It's their game, and they don't care about your targets and your time and whether you want to be profitable this week or this month. It's their decision to fill their book, exactly liquidity pools, whatever it is that you want to call it. Yeah, but it's the avoidance of slippage, and we have no idea on how long that's going to take. Yeah, but eventually it will go in its direction. Yeah, so all we do at Trading 180 is look to buy at levels, right? And then look to at bargain zones, and then look to the medium to long term type trades. And of course, they can work out in the short term as well. Trades do definitely work out in the short term all the time. In fact, the group has had a very, very good week. Marianne can attest to that. The New Zealand dollar, everyone's been buying the New Zealand dollar and have done very, very well over the past few weeks. But that must be explained. That has to be explained. And if you can understand that, it's not every single day you're going to get a trade. It's not even every single week you might get a trade. Some weeks you might not get no trades. Some weeks you might get 10. Nobody knows when the trade is going to come, but we have to just take the right opportunities and the best opportunities, and really good opportunities don't come around every single day. I can promise you that, in a way, if you understand fundamentals. Anyways, buying the rumor, right? And what is priced in. So ultimately, fundamentals is all about buying the rumor, right? This is what we do. We buy the fundamental rumor, yeah? Because you've heard buy the rumor, sell the fact. Buy the rumor, sell the fact is basically the rumor starts early. Yeah. There's a rumor that a central bank is looking to hike rates at some point. Yeah. The financial institutions will know this well ahead of time because they read the banks, they read the central bank statements, they understand inflation, they understand GDP, they understand what the central bank is going to do. Yeah. Because again, they understand the rules to the game. So they buy down here, right? They buy down here. And they've been accumulating. All the retail traders will say, oh, that's a choppy market. Prices are trending down on a 5-minute chart. I'm going short, right? Not understanding that, in fact, the rumor has been starting. And by the time the rumor comes out, they've made their money. That's basically what happens consistently. They're not looking to buy on Forex Factory, yeah, on the day that there's an interest rate hike. That's not what they're looking to do. There's no way they're looking to do that. Yeah, exactly. It's already been priced in. What has been known about it has been priced in. The price was down here. They're pricing in that hike. So by a week or two before, it's already priced in. Yeah. So you're buying with fundamental analysis, you're always ahead of the curve. If you know what to look for, if you know what you're doing, if you know the rules to the game, you're always ahead of the curve, always. That's just by the very nature of fundamental analysis. You're not coming to the market thinking to yourself, all right, tomorrow they're looking to hike rates, because you would have known this from, weeks and months ago. Yeah, months ago. Anyways. Buying the rumor. So let's go through an example. How will you know whether a scenario is priced in? Again, you will know that if you understand, if I would say that, well, put it this way, the closer to the fact is, it means that it's already been priced in, right? We look to buy, and I say I've been buying the New Zealand dollar for probably maybe about a month or two ago, right? I was buying the New Zealand dollar. I'm not saying that every single trade was a fantastic trade, because I don't know where the exact turning price was, but that's not necessarily the job of me. The job is for me as a trader, as a technical trader, not necessarily fundamentals, my technicals, is to limit my downside, but when I'm right, make money. Yeah, you had a trader RM this week who made an 11-to-1 trade on the New Zealand yen trade, an 11-to-1 trade, right? And he held it for what, 2 weeks. 2 to 3 weeks. Yeah, he didn't know whether it was going to turn around there, but the point is that when we lose small, and when we win big. And when we win and we're in a trade, we ride that trade, right? We can add into that that trend. It's not just one trade you're taking, because a lot of times, and I'll show you one here, you can see the trend coming, right? You know the trend is coming, and you're just adding in on pullbacks. Yeah. So anyways, this was euro dollar, right? What are we at? 21. Cool. I should finish this in about 10-15 minutes, right? So buying the rumor and what is priced in. So euro dollar, September 2020. Yeah. September 2020, right? We had, in fact, let me just zoom out a little bit. Right. So we are around here. So we had a shift in the fundamentals. Yeah. So this was September 2020. And prices was around about the 119.50. Yeah, at that time, we had September the 3rd. Yeah, so you can see that September the 3rd. Let me just zoom in a little bit so the guys can see. September the 3rd, beginning of September. There was an article in ING that said FX, the dollar bear trend has only just begun. The fiscal policy paralysis and a change in monetary policy strategy from the Federal Reserve make the case for the dollar bear trend extending well into next year. We revise up our end 2021 euro dollar forecast to 125. Boom, right? They're speaking our language, right? They understand, and we understand why, the euro dollar should go to 125. Monetary policy, yeah? Cool. So what happened? Did the dollar go straight up, straight away? No. The market saw this. They don't want to buy the dollar at highs, right? They want to buy the dollar for cheap. So during those weeks, September into October, right, into November, who was doing the buying? Who was doing the buying? Yeah. That week in history where you saw that massive, 1, 2, 3, 4, 5, 6 candles. Yeah. Many traders would have been like, fundamentals don't work. Why is the euro going down? Because the smart money are buying for cheap, because they understand they got the projections, because ultimately, where did price eventually go? They had to take their time in accumulating and buying. We don't know how much they're buying, right? It could be a billion, it could be 5 billion, it could be 100 billion. No idea. But the point being is that when you know the bargain, yeah, when you know that price is expensive and you can scale in, and you can, you might lose a trade or two, cool. But when you win, you're winning way bigger, way more. Yeah, all these pullbacks were absolute bargains. Yeah. And then look what happened. Yeah. Then we come to, so by the end of the year, prices went to the 123.50. So close enough to the to that 125 target. Of course, the banks aren't always 100% correct, but they were correct enough in the direction eventually for prices to go higher when they were accumulating. So all that we were doing at the time was looking to buy at certain areas, the euro against the dollar, and short the dollar. And that's it, ride the trend up. Then in January, end of January, February, right? There was a shift in the fundamentals. So let's go to the next slide quickly. Yeah. So just in case you guys, generally think that I'm just talking, right? Just talking. This is a live screenshot of the group, and you can see Leon wrote 27th of January 2021. So I'm going to read this to you. Let me zoom out a little bit. Right, I'll read this to you. I said, hi, everyone. On the 27th of January 2021, I've been reading a few articles, and there seems to be a bit of a shift between buying euros and selling the dollar in the short term. Yeah, it looks like Europe is lagging behind behind the US in terms of the vaccine rollout. Right, the vaccine rollout, if you understand, that it was a GDP play, right? So GDP was directly correlated to the amount of people that were getting vaccinated, right? If an economy had a strong vaccine uptake, meaning more people were taking the vaccine, then the idea was that they would recover sooner and GDP could grow, lockdowns could be lifted, and GDP could grow faster. This was the trade that we were trading, yeah. So it was all about GDP. So rollout, therefore projections for GDP will also lag. So let me just read that again. It looks like Europe is lagging behind the US in terms of the vaccine rollout. Therefore, projections for GDP will also lag. So for the short term, by the way, short term 1 to 3 month time period, right? I'm looking to see if there are any buying opportunities for the dollar, as long as the data supports my bias. So the data to look for is growing GDP for the US dollar and lagging for the euro, right? Pointed it all out. The ECB are potentially being forced to do something about the unwanted strength in the euro. So again, remember I was saying to you that an expensive currency hurts GDP, yeah? An expensive currency can hurt GDP. And central banks, especially the European Central Bank, yeah, didn't want an expensive euro, because when the euro was up here, it was expensive for them, right? That's an expensive euro. Yeah. So they're forced to do something about their unwanted strength, meaning that they wanted to weaken it. So I said, please see the Eurozone channel, yeah, for the latest, which means they may have to find a way to weaken the euro. The Fed has been winning the currency war, currency devaluation over the past 6 months, but now that is translated into potential growth for the economy. Again, as I said, a weaker currency or a devalued currency can boost GDP. Yeah, it helps GDP. And the US at the time had been winning the currency war, which is currency devaluation, which is what you want in a recession, right? If you're trying to recover, you don't want an expensive currency, you want a cheap currency. So, yeah, but that is now translating into potential growth for the US economy. So again, any positive GDP and inflation news from the US supports a dollar buy bias for the short term 1 to 3 month period. Of course, this is not financial advice, just my opinion. I'll cover it in more detail in the evening's call, which I have every Wednesday with the guys. And we did recorded. If you guys join, then you'll see, you can go back to that and see exactly what I said. But that's proof, yeah, that I talk what I trade what I talk, right? And that was back in January. So back in January, we were looking at this. Again, we got a short trade. Our bias was to the short side, right? All we were looking at is short trades. Look at where the trade went. Right? That's it. The data supported the narrative to go short. That was a good, how many 100 pips? Maybe about 400, 500, 600 pips. Yeah, to the downside. That was it. Yeah. Then we had in April, yeah, a bit of a semi-convergence, right? So this was a bit of a different trade idea. And the trade idea was more to do with euro area started to grow, right? So you had a weak euro. So euro area companies returned to broad growth on vaccine optimism. Yeah. So private sector, with basic expansion, I'm not going to read it. But the point being is that on the chart, we started to have what was seen as a bit of a convergence, right? So the US, sorry, let me do a different pen, a different tool, right? So the US were looking to strengthen, right? But what was happening, and the euro was looking to weaken, right? But what was happening was, once the euro started to strengthen, yeah, because of the vaccine rollout, the divergence then became converged, right? So it was a wider divergence there, and now it started getting smaller and smaller and smaller. And in that convergence, what you then started to see is the gap was closed between the dollar and the euro. And the euro went on a bit of a run. Matter of fact, it was definitely not what I was, totally expected. I didn't think it was going to come all the way up here, but it ended up going all the way up there, right? But that was a convergence trade because rather than seeing this, the market was starting to revalue the euro, and the euro started to recover and started to get a lot more expensive in comparison to the dollar. And that was what I call a semi-convergence trade, because the dollar wasn't necessarily weaker. Yeah, it was just that the euro was catching up and the market priced that in. Yeah, so that was April. And you started to see it here, for example, with GDP. Don't know if you can see that GDP area, annual growth started to catch up, right? Then we had in June, right? In June, what did we have? We saw Fed dot plot seen shifting to 2023 rate hikes, lift off, economists say, and we also had Fed sees 2 rate hikes by the end of 2023. So now they really start to ramp up, yeah? And what do we see in June? Shifting the fundamentals, the dollar getting much stronger, the euro actually was getting weaker, and then we saw the beginning of this downtrend, yeah? And then the latest one, in fact, so tapering, yeah, is the reduction of the rate at which a central bank buys new assets. It's most commonly used when talking about the reversal of quantitative easing. When you're reversing quantitative easing is devaluing a currency. When you're reversing that, it means you're not devaluing the currency, and is regarded as the first step towards winding down from a period of monetary stimulus. So in fact, you're not weakening your currency anymore. And then the final one, 22nd of September. And again, I had a YouTube video. Not sure if many of you have watched this, but this was a live masterclass on trading the FOMC. Yeah, right here on YouTube. Yeah. So again, when I'm talking about something, I do trade it. And what we had on the 22nd of September was the Federal Reserve left monetary policy unchanged, but there was a clear intent to dial back stimulus this year, which is positive. QE tapering is set to be announced in November, with the committee shifting towards a 2022 rate rise. So again, from the 22nd, what do we see? More selling off. Yeah, so the rumor the data still supports that narrative. Yeah, the data was still supporting the fundamental narrative. Right. Everyone follow that, by the way. Everyone understand what was going on, yeah? Everyone understand what was going on? Everyone's following? Any questions? Yep. That's it. That's it. This is what we do. So what is risk-off sentiment? You have to understand risk-off sentiment as well. Risk-off sentiment, yeah, because generally people think risk on and risk off is a light switch. It's not. There's varying degrees of risk. So the term risk off is used to describe the risk sentiment where traders and investors in the financial market reduce their exposure to risk and focus on protecting their capital. So in a risk on environment, meaning you're putting risk on the table, you're willing to take money out of your pocket and put it into the market, is what we would classify as when everything is lovely in the world, right? Where there's no problems, coronavirus is totally all but gone, there's no wars, there's no elections, everything is fine. And a risk-off event is when you have fear, uncertainty, doubt, in the market. Think of last year, March, April, where the coronavirus was at its height, was at its peak. That is what you would call, an absolute 5, right? That would be known as what is 5. An absolute, total world shutdown. That's the most extreme risk-off event, hopefully we'll ever have to live through again. Do you know what I mean? But that would be what is known as a 5, right? And then you've got neutral, right? So it's not just necessarily just risk on and risk off. There's always going to be risk events. Ultimately, what you want to do is, if you're trading risk off, meaning that you should be probably buying the Swiss yen and the Swiss yen, that's the Swiss franc and the Japanese yen, yeah. Money tends to typically flow into those safe haven currencies, yeah. You want to buy those currencies if the risk event is something that is going to be long lasting, rather than just something that can be resolved in 2 weeks. And ultimately, I'm not necessarily a risk off trader, right? As far as I would risk off can push prices to where I want to be a buyer, right? Because the market is more risk on than it is risk off, meaning that markets generally will go, we tend to go higher over time rather than go down over time, right? So because ultimately, as human beings, we're always looking for growth, economic growth, right? And we always find a way through whatever risk off event there is. So with that being said, there are periods of risk off, and when you find an event, right, because you've got risk off events, can be local or global. A local risk event are things like elections, Brexit, natural disasters, etc., in that country or certain regions of the country. So, for example, with Brexit, it was the pound, it was the UK and the Eurozone, right? But what did Brexit have to do with Australia? Nothing. Well, I think trade relations fine, but from a economic perspective, it was just affecting Europe and the UK, right? It didn't have anything to do with Switzerland or Canada. You know what I mean? So it's more, you've got local risk events, and then you've got global risk events, which are those events that will affect generally either global finance or global trade. So anything like, for example, again, a few years ago, you had the trade war between Donald Trump and the US and China, right? That was something that affected the world. We had a recent one where you had coronavirus, right? That affected the whole world. So you have to distinguish between risk off, which is local, and risk off, which is global. So if you can distinguish between those two, then you can understand which pairs to buy or sell. Also, as well, keep your eye on correlated markets like gold that work inversely to the dollar. Gold is a risk off asset. So in times of uncertainty and doubt and high inflation, gold generally will start to rise. And I say high inflation, I'm talking about really high inflation. Oil, stock market, and government bonds, government treasury bonds, which are government debt, is always worth keeping your eye on those markets, right? So that brings us to the end. Before we get to the Q&A, just quickly, I have to say this, that now that you know the fundamental rules, right? These are the fundamental rules. You can actually go off now, or you should be able to go off now and literally trade this stuff, right? But the question I would ask you is, what high level skill can you really acquire without seeking a mentor? And the mentor doesn't have to be me, by the way. It doesn't have to be me, but I'm just going to give you some advice, right? Some advice in if you want to be successful in any endeavor, is seek a mentor, someone who has done it, and it really does cut down the learning time. And there's no skill, high level skill in the world that you can learn and become proficient at in just watching webinars and YouTube videos and TikTok videos and Facebook videos. It's impossible. I know there's a thing of, oh, you know what, I can make my own strategy here and there. Fine, brilliant. Do you know what I mean? But you need, for me anyway, you need a mentor. And if you've been trading for any length of time and you haven't seen certain results, try and get a mentor, right? Because you'll get guidance, you should get feedback, you should get support, right? And I know I offer this through my Discord channel. The guys know, I know Marianne knows, I'm very, very active in my group. I create videos for pretty much every question that you might ask. I get back to you. We have weekly Q&A videos. I've got thousands of hours of videos on there for you to watch. And also as well, you need accountability, right? Sometimes you're sitting at home and you're literally like, okay, should I do this? Should I do that? In the group, we can't tell you. It's not a signal service. We're not trying to tell you what to buy, what to sell. But what we can do is support you, and you hold me accountable and I hold you accountable, right? Send me your last 10 trades. People, you'll find that, with trades that you think are great, when you're on your own, when I analyze them or when the group analyzes them, maybe they don't seem so great, right? And the fundamentals as well is something that you really need, I think, guidance on. Yeah, you really, 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 really need guidance on fundamentals. Again, the rules, trust me, you can go off now and trade it. But if you want to trade with like-minded traders, we have some really, really great experienced traders in there. that are doing really well, and we can all help each other at the end of the day. But if you do want to join me, I'm just not taking any and anybody. I'll tell you that now. I'm not going to do it. I tried to do it in the past. It's a bloody headache. So there is a barrier to entry. You have to have at least, if you want to, with me anyway, if you do want to sign up with me, you have to have at least 1 year experience trading real money minimum, right? And you have to be in them. There's been some people have slipped through the net, right? I've had a 15-year-old. So you've got to be at least of age, at least 18 years old. Also as well, please make sure that your bills are paid. If you're looking to trade, if trading is like your only source of income and you need to make it work, do not do it. Again, I've tried it. I've tried to, because ultimately you won't listen to me, right? Because you're going to make all the wrong decisions based off of your financial situation rather than trading in a stress-free, pressureless environment. Yeah, it's weird. It's like an oxymoron where it's like you can't. Maybe that's not the word, but like to trade successfully, you can't focus on the money. You have to focus on the process. And if you have subliminally that pressure on you, yeah, to have to make money this week, to have to make money this day, it's just not going to work for you. Trading, period. Not just me, just literally anywhere. If you've been anywhere and taken many trading courses, most of the time it's not even them. It might be them, but generally it's you. Do you know what I mean? And the fact that you can't follow instructions because of these subliminal pressures, right? So, your trading expectations, no get rich quick schemes, none of that. Yeah. And this is going to be some hard work, by the way. It's not going to be, I'm not promising you that it's going to be, you're going to learn this in 1 week and you're out. Listen, this is going to be, tough. You got to put the work in. If you're not willing to put the work in, again, I wish you the best of luck, you know what I mean, in your endeavors. Yeah. But there is a barrier to entry. If you don't fit that criteria, please don't waste your time. Don't waste my time. Don't waste your money. You know what I mean? I am only looking for certain people, and enrollment does end this Sunday, and then that's it for the year. I'm done for the year. The people who are in, and we'll do, what we do. So Sunday really is the deadline. But also as well, even if you don't choose to come with me, or you choose to go with someone else and find another mentor, I would say definitely buy the book, The Art of Currency Trading. Brent Donnelly, at least invest in that, right? At least invest in that book. Please, 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 please. If you take anything away, outside of this, outside of what I've told you, please, read that book. That's the fundamental analysis Bible, to be fair. So there's that. Anyways, guys, Q&A, right? Fundamental analysis Q&A, and only fundamental analysis, by the way. I'm not talking about any kind of technical analysis. Just fundamentals, what we've covered today. Remember, I said you don't need to know everything about everything. Don't ask me about things that aren't covered in this, because I'm not going to answer them. But if you have anything that is covered in this that you're not truly or fully, understanding about, then I can go over it. I've got another, I would say 20 minutes, 15 to 20 minutes. So guys, questions. So Marvelous Edwin said, but during COVID, Aussie yen was going higher. Right. That's a great point. Right. The reason why, and that caught me off guard as well, Marvelous Edwin, or is it Edwin Marvelous? Or Marvelous Edwin, right? What was happening there, yeah, was the market was actually anticipating the recovery sooner. If you go back to that period, you'll see, I think there was I think it must have been maybe April, May, you saw like a bottom, and then all of a sudden, all you saw is this massive uptrend, massive uptrend. And the reason why is because the Australian economy, yeah, was doing the best in keeping COVID down. That was basically what was happening. In a risk-off environment, typically, and by the way, and that's the reason why I use the word typically, because there are anomalies in history, right? We know what typically happens, yeah? But you also have to understand, and you can't just say, all right, and these are the rules, and this is how it's going to be 100%. This is the reason why you need a mentor to guide you, right? To guide you for you to see these things, right? So, but at the time, there was literally the idea was that, or the trade idea was that there was lots of traders going short, including myself, right? Including myself going short at certain levels. And then all of a sudden it dawned, it dawned on me that in fact, it's because of the vaccine rollout. And then you just switch your position, right? The vaccine rollout was the reason why this wasn't. And in fact, the Japanese yen was struggling with the vaccine rollout. They were going back into lockdowns. So even in a risk-off environment, the smart money, we're looking at growth, GDP recovering, and they were right, because ultimately the Australian economy recovered way faster than the Japanese yen, even though they've kind of gone back into a bit of lockdown and problems and stuff like that. But at the time last year, that was the trade, right? That actually was the trade. I can tell you this now, every major price movement I can explain, over the past, maybe 6-7 years since I've been trading fundamentals, I can explain with fundamental analysis and risk sentiment. Any price chart, I can explain with fundamentals. I can tell you what was basically happening at that time. Right. Next question was more active than, Marianne. Yeah, I'm definitely more active. So Ariane says, I'll be in London tomorrow to kidnap me. Okay. You don't need to kidnap me. You can just join the group, mate. You can just join the group if you want. It's for less than literally a cup of coffee a day. You know what I mean? The minimum is like £1.30 or something like that a day. It works out to be. Jack says, thanks for the webinar. You're more than welcome. Maurice Morori, I think that's how you pronounce it. Would you say Aussie New Zealand is a good divergence? In fact, I'm in that short. Made a bit of money on that so far. And the reason why I would say, again, it's not financial advice, of course, not financial advice, but there's a divergence between the central banks, right? So you've got the RBA, who are basically saying they're not looking to hike rates at any point. And then you've got the RBNZ. In fact, I've done it the wrong way around. Sorry. The RBNZ, are the ones that are looking to hike rates, so that's going up, and the RBA, are not. So there is a divergence there, and that's, again, if you actually look at the Aussie New Zealand, I think maybe over the past 4 or 5 months, it's only really over the past maybe couple of weeks since they hiked rates, since the RBA hiked rates in, I think it was October, maybe beginning of October, that you started to see a bit of a uptrend. But if you look at actually what was happening throughout the whole year, basically there was a massive downtrend, and it's just pulled back between the yearly high and the yearly low to fair value, which is 50% between an expensive and a bargain area on the Aussie New Zealand. Zoom out to that daily, you'll see it. So ultimately, there is a divergence between the two central banks. So me personally, I put a small position on, not the best, it's not my favorite trade in the world, but I put a small trade on, and I'm in profit on that one a couple of days ago. Dixon Method says, can you explain a little about CPI, PMIs? Okay, it's just basically CPI is consumer price index. It's just a measure of inflation, right? And I think PMI is a producer manufacturers index, and again, it's just a way of measuring inflation. Non-farm payrolls and retail sales, it is what it is, right? But we want to focus on inflation, right? Another one is things like jobs. Jobs is an indicator. Wage growth is quite a decent one when it comes to inflation, but ultimately just focus on overall inflation, right? As I was saying before, Dixon, retail sales, just look at GDP, inflation and interest rates. Trust me on that one. Obviously be aware of these things, because obviously retail sales does have an effect on GDP. It's all these little things that will obviously affect the big things, right? So you definitely have to keep aware of it, but ultimately the market will move eventually based off of the relationship between GDP, inflation, and interest rates. You don't hear central banks, I'll pay you £20 if you can find a central bank that has mentioned retail sales in a report. Hold me to that. Be doing a lot of reading. Focus on what the central bankers are saying. They don't mention retail sales. Thanks for the info. Thanks for the info. What do you think about seasonal tendencies? If it's not in the webinar, I don't. You know what I mean, Omar? I don't think about seasonal tendencies. Not when it comes to currencies. I know with, for example, grains, seasonals, and certain commodities, of course, you have to look at, the seasonals. But when it comes to certain things, I know like gold as well, they have seasonal tendencies. But in commodities, in the Forex world, I haven't ever looked at the effect of seasonals. And if it did mean anything, A, the central bankers will be talking about it. B, the big banks will be talking about it, and I've not read an article regarding seasonal tendencies. What it says, why does currency rise when PMI fall? Ian, come on, you can do better than that question. Savior Mayanda says, when does the bias for the fundamentals change? Oh, good question. Is it the data or the statement which is more important? Excellent question, Savior. So when it comes to, what time is it now? All right, we're another 10 minutes. So when it comes to, I would say it's more to do with the data. You're ahead when you keep your eye on the data, yeah? Because ultimately the central banks are not they need the data to support the policy, yeah? So they're both as important, but we can get ahead of the curve if we understand that, if we understand that for example, inflation is trending higher, for example, right? Because we might see the latest report for inflation before, for example, the FOMC, right? So FOMC, which is normally on, I think, is it the Wednesday or the first Wednesday of the month or something like that? If we see inflation reports and they've been trending up, we pretty much know but we understand, we have an idea of what they're going to talk about at FOMC. Yeah. So it is the data that is the most important. It's a leading indicator in a sense, because then they're looking at the same data as us, and then they're going to make because they apply the rules that I've just told you. They can't hike rates. They're not going to hike rates if the economy is going down, right? They're just not going to do it. I was saying this, and Marianne will attest to this. I was saying I'm going short on the pound. Yeah, sorry, GBP, right? From a few weeks ago, because I couldn't see why the Bank of England were looking to hike rates, and you had recent GDP numbers come out as, I think it was like 0.2 or whatever it was. And then you've had the energy crisis, you've had petrol crisis, you've had furlough ending. It was just too much. And you know what I mean, for the central bank to want to hike in this environment, I didn't think it was going to happen. But what they were trying to do was talk up the pound, yeah, by saying that they were going to do it. Because again, if you guys have been listening to me, if prices go up, yeah, if price goes up, what happens to inflation? If things get more expensive, what should happen to inflation? Should it go up or down? Should inflation go up or down? If prices get more expensive, what should happen to inflation? Adrian, good man. No, Vitali, wrong. Maurice Maury, excellent. It should go down, right? And that's what should happen. Yeah, that's what should happen to inflation. Yeah. So what the Bank of England were trying to do was they were trying to talk up the pound. And then I just showed you an article on Bloomberg saying that now they backed away from looking to hike the pound, right? They backed away from it because it doesn't make any sense. They can't hike in the exactly, despite shrinking GDP, John. That's exactly it. That's exactly it. They had no choice. But I understood it because I'm not smarter than anybody else. I'm not smarter than you. I'm not smarter than anyone. I just know the rules to the game. That's it. And the rules are the rules. They're bound by the economic rules. It's not my rules, it's their rules. Yeah. So that's basically what it was. Let me just scroll back a little bit. But great question, by the way, Savior. Great question. Ian, what is currency like markers, small leading indicators? Now, don't worry about Ian. Don't worry about the micro to macro. Remember, I said to you guys, and I hope who's listening is I don't have to know everything about everything, yeah. And it's not necessary to know these other things. Your mind can wander off into all these other things. No, focus on what I've been telling you and digest that. Don't think about other things if you haven't mastered this. You know what I mean? Small leading here, no worries. Thanks a lot for the information. No worries. Apoku Emmanuel Maurice says the issue on Aussie being supported by increase in oil prices, is it short term or long term? Who knows, right? Who knows? Oil prices, I would say Canada is more supported by oil prices. The Aussie being supported more by commodity, an increase in commodity prices due to supply chain problems. So if commodities start to go higher, then that supports commodity currencies like the New Zealand dollar, the Australian dollar, and the Canadian dollar. So as long as there's higher commodity prices, then you'll probably get a higher commodity, and that just adds to the buy, right? Marvelous Edwin says, please can I make payment for the mentorship program monthly? Unfortunately not. I stopped that monthly because people just weren't taking it seriously. And in all honesty, you're not going to learn anything in a month, right? I mean, you're going to learn something in a month, to be fair, but you know what? If you've got to be committed, yeah, you have to be committed. And if you're not committed, you're just wasting your time, right? You're just wasting your time. And again, think about it like this. For 3 months, it's less than a cup of coffee a day. Like it's literally £1.30, £1.30 a day for 3 months. That's it. That's the price. You know what I mean? If you can't afford that, I don't know what to say. I really don't. I know everyone's in different, financial situations and stuff like that. But trust me, guys, if you're in dire financial straits, believe me, trading is not the one. No one's going to tell you this, by the way. There's no other person that's going to tell you this. You're better off doing overtime, doing something else, and doing that, right? Until you get yourself into a position where you can afford to trade stress-free. Yeah, don't be driven and don't get caught up by the Lamborghinis, the fast money and things like that. Please, I'm telling you this. Yeah, I've been there where you are. It doesn't work because your mindset is always going to be on, you're going to be FOMOing in, you're going to be missing trades. And it's not a great mindset to be in. It's not conducive to trading, right? So unfortunately, and this is why I say you have to have your bills covered. Trading should not be something that you absolutely must do. And if you don't make it a success, if you don't make money this week, then you're just not gonna, you're not gonna make it. Because don't do it to yourselves, guys. There's many other ways. Start a business, get into property, do some savings, whatever it is. Take it slow. This is not the game for you. This is not the game for you. If you're in that situation, come back in 6 months, get your money up, do your thing. You know what I mean? Get some savings under your belt, sort your family out. You know what I mean? Do it that way. I'm telling you, no one's going to tell you that. Yeah. No one's going to tell you that. I'm looking out for you in that sense. Yeah. Because otherwise, like I said, I'm not, please, I don't want to trade with you. Do you know what I mean? I've done it in the past, and you're just going to waste your time. You're just going to waste your time trading, period. Do you know what I mean? So I'm just going to be honest with you guys. Please make payment. Okay, so thanks for your time, much appreciated. You're welcome. Omar. Jack says, once you put in a trade on, what is your time horizon? Okay, my time horizon is whenever the trade works. So I will split this is from Jack, so I split my trades up into 3 positions generally. So I'm on, depending on how many trades I get triggered into, because one's a market order and 2 are pending orders. If I get triggered into any of the pending orders, that would be my short-term trade. So that would be generally like a 2-to-1 type trade. And then I will swing trade the market order. Yeah, so I'll always swing trade one position. If I get triggered into three positions, then I will take profit on one position early to get myself to a profitable position situation, and then I will either swing trade the other two positions or take profit on maybe the second position somewhere, and then I'll swing trade one position. So that's what I'm always doing. I'm trying to I take advantage of the short term and the long term, right? So that's how we're doing it. Yeah. So hope that answered your question, Jack. Fundamentals to take. So sorry, I didn't read your question properly. So once you put on a trade, what is the time horizon? Do you wait for fundamentals to change to take profit? Okay. So I manage the trade with the fundamentals. Fundamentals don't change like daily, day to day, or week, or even week to week. Generally, you can have a trade idea, right? You can be in a trade and have a trade idea, and that trade work out, and you can literally trade for months and even years. Don't know if you saw my I think I did it in 2019. I did so it's on YouTube. If you type in fundamentals, and I'd basically say, I think the title's called something like a fundamental analysis in under 60 minutes or something like that, where I literally go through the euro dollar. I was trading the euro dollar for a whole year going short. Yeah. And if you look from 2019, 2020, euro dollar, all I was doing was going short because I understood the fundamentals. Go and look at the euro dollar, guys. 2019 to 2020, short trades all the way. That's all I was doing. So if you have a trade idea, it can last for a while, but then what I'll do is I'll manage the trade depending on the fundamentals. I might come out, but generally I'll have predetermined targets, and they don't change too much. Hopefully I answered that question. So please repeat about changes of GDP and effect on currency. You know what? I'm coming up to time, Dixon. You're going to have to probably watch this back again. Watch the video back, which I'll post to you within 24 hours. John Samuel, what if inflation blows the roof? Well, buy gold. I would say, John, you want to buy gold and silver. Oh yeah, and how to predict GDP data. That one is you have to kind of look at maybe the little things. That's when you kind of do look at the little things, but there are forecasts, right? There are smarter people than us forecasting, yeah, GDP, right? So here you go. Here's one. No need to stress or forecast, right? It's all here for you if you know where to look. Yeah. So GDP. Let's go to GDP tab. Yeah. There we are. Here are the forecasts. France 4.1 or UK 6.8, 6.8, 9.6. The smarter people have done the work for us, right? That's basically what their prediction is, GDP. So there you go. The central bankers have no choice despite the shrinking GDP. Yeah, we were talking about that on the pound, Savior. That's more clear because the question originated from the fact that you was long the pound against the yen and the Swiss. Yeah, because and that was I was long the pound up until I think maybe about a month ago, and then I changed my bias. But again, the yen is worse off than the pound, right? The pound, they just can't hike rates anytime soon. Yeah. And there was also the rumor that they were going to hike rates. So there was people buying into that rumor, right? Which is the reason why you saw the buy the rumor, sell the fact. Yeah. But if you're in that trade, yeah, you might want to look to take profit at some point because it's actually at highs now. But the yen and the Swiss franc was still way behind, right? They were still way behind. So although I wasn't necessarily a buyer of the pound, if you think about the divergence between the pound and the Bank of England and where they were, considering the rumor that they were looking to hike rates, even though I didn't believe it. Look at what happened to the pound yen. Look what happened to the pound Swiss, right? It was a buy. So you're not wrong. You're definitely not wrong about that. John Samuel says crypto payment. No, I don't. I will though in maybe in the future. I'm looking to accept possibly, but I've got obviously, there's tax and things like that. So I've got to sort that all out. Absolutely looking forward to joining the group next year if it'll be available. That is, it'll be available next year at some point. Maybe not when you want it, but it depends. And I look forward to working with you whenever you do join. Can you please send a recording after you joined 10 minutes ago? Unfortunately, no worries. Of course, I will email it to everyone. JS Okay, thanks. Euro dollar 2019. Yeah, there was a Marianne. I'll put the video in the Discord room so you can see it. I'll put it in Discord room at some point, probably tomorrow, Marianne. Yeah, Adrian says he's seen. I'm assuming he's seen the video that I was talking about 2019. And again, I was talking about interest rates, GDP, and inflation. Okay, we'll check you out because there's bank restrictions here okay, in Nigeria, really? Okay, that's unfortunate. You know, the video can't make international, and you can't make international payment. Oh, that's a shame. That is a shame. Okay, all right. I'm assuming that all of the questions are done. I am going to call it a night. Bloody hell, 2 hours and 5 minutes. I thought it would take me a bit shorter, but it didn't. So yeah, guys, if you do want to, yeah, ING is a free site. Look, if you do want to join, just go to Trading 180 and basically just sign up, and I'll see you in the Discord room. I'll be up for the next maybe hour or two just to sort out any issues that you may have. If there is any issues, there shouldn't be no issues, but joining the Discord group, I've got to give you access to all the channels. You can't just come into the group and then access all the channels. I've got to give you access because there have been some people sharing my links, so I've got to verify you. So if you're going to join, I'll be up for the next hour or so. But if not, you know, I wish you all the best, guys. And again, you know, I do close the enrollment on Sunday at the end of Sunday, close of play. Anyways, guys, have a great evening, and I hope you learned a lot from this. And yeah, brilliant, guys. Take it easy, and speak to you all soon.